Welcome back, everyone, to an episode of Hot Takes with Kari and Keelan. It is May 10th, 2024, and this is episode number 20. I am Kari Rae Davis with Kari Sells the City and Keller Williams.
And I'm Keelan Harvey with Harvey Home Team and Highlands Residential. I forgot about that part.
Yes, you are with Highlands Residential. So,
Yeah.
Keelan, I wanted to go over a couple of things that have come up for me over this last week. First off, I want to talk to you about where rates are at because I always want to touch on that. But I also want to touch on adjustable rate mortgages. I feel with what's going on with interest rates that those types of mortgages are coming back up in conversation. And that's not generally something that I recommended for my clients. So I wanted to get your take on them and get your thoughts and feelings about that as well.
Sounds good to me. Yeah, I mean, last week, great for rates. I mean, we had 3 days back to back. Between the Fed announcement, we had a good jobs report. That Bureau of Labor Statistics I always talk about that's done us dirty for like a year and a half.
Right.
Like 90% of the time it's been bad. It actually came good for us this time. So 3 days of rates improvements, which is really good. Kind of been stagnant this week. We have another CPI report, Consumer Price Index. Remember how I explained inflation is the arch enemy of mortgage rates? That's the big inflation report next week. So we'll see what happens.
Okay.
But the thing I'm excited about is maybe this is the turn of rates that we've been hoping for. I don't think the Fed is going to cut rates in June. They won't. They talk about the soft landing to 2%. But some are hopeful that they would cut it in July. They haven't taken a couple cuts off the table. And I mean, elections are not far, and you'd think there'd be some things that are happening. We're running out of time. So, I mean, in hindsight, it kind of looks like it might be the turn of rates.
Okay. Well, that's always comforting. I mean, I told some people at an open house this weekend that rates had improved a little bit. And I think they kind of looked at me like, what? And it's like a little improvement does a lot for us over here. So don't
Absolutely.
think that those little improvements aren't going to equal greater value later.
Yeah, I mean, we'll take anything we can get at this point. Like, it's been so persistent with rates being higher. I think everybody's kind of digested it and used to it.
Right.
I feel like with customers at least they know what it is. And my tune hasn't changed. I still feel like this is going to be the new 2020. I feel like the time where it's like everybody wished they would have. I think that's the case. And as time goes on, I think that opportunity is going to get smaller and smaller as rates go down. So,
Right.
but I'm hoping that's the case, and we might have a funky summer. We'll see what happens.
I'm very interested to see what this summer looks like because as we spoke last time, if rates come down midsummer and we get a flush of buyers that are active on the market, and normally in our area, August is a super quiet month. There's just not a lot that happens. Like people don't really list their properties in August because it's just not a good time to list. Nobody's in town. But I'll be interested to see. I'd be happy if it was busy. So I'm not going to say no to having a hot August. So.
Yeah, me too. I think we'll see what happens with inventory too. Obviously, inventory is very tight. So I think there's going to be a transitionary period there when rates go down and inventory is low, and hopefully we can free up some properties from those step up buyers, people that are sitting on a bunch of cash. But I think when that happens, it's going to be on fire.
Right. Get ready. Long weekends again.
Yeah, we're not going to sleep very much anymore. It's going to be
Right.
like the good old days.
So yeah, now let's discuss these adjustable rate mortgages. I've always, I know that they were really, really big in, before the crash in 2028 when all of that happened. And so I've always kind of had this stigma against ARMs because I just felt like it wasn't a smart way to go. But that might just be me not being educated enough about them. And I wanted to get your take. What do you think about adjustable rate mortgages?
I think they have their place, and that you feel about it is how most people feel about it. Because if you've been through the 2008 mortgage meltdown, then you just got a bad taste in your mouth about it. It's almost a swear word to some people you talk to because there's been some serious, not good things happen to people because of it back in 2008. Life altering events. But there's more to the picture. 2008 was a very different time. Those mortgages back then were very different than the ones we have now. They had like full on predatory loans back then. It was crazy. You could first of all, you could write a number on a piece of paper for your income without any verification at all. So, I mean, if you want to get ahead of your, fortunately, a lot of people did back then, you could buy more home than you could afford. And especially a lot of those ARM programs were interest only loans with like balloon payments. I
Okay.
mean, they were not good things. And I've talked to people that have gone through that, many people that have gone through that. And I think there's two sides to that story. Of course, the mortgage companies were providing the cheapest possible mortgages ever, interest only, not proving income,
Just getting
and
people in the door.
yeah, I mean,
Right.
I hope they'd explain it to customers. Maybe some of them did, maybe some of them didn't, but I will tell you, a lot of customers forgot what they signed up for. So, you imagine you sign up for this property and you're paying interest 7 years. You forgot that that principal payment's going to kick in eventually, right? So one month you get a mortgage statement that says your payment's 5 times as much as it was before, or 4 times what it was before, and now you're panicking because you're like, what the heck happened? What did they do to me?
Right.
When maybe you didn't know about it, but at the end of the day, those are the type of programs back in the day that have people have a bad taste in their mouth. I mean, for good reason.
Sure.
I
Why
had
would
friends
you think
that
that why would you think they'd be a good option now?
So now times have changed. So because of that, it's kind of a blessing in disguise because all regulations changed. They went really hard on regulations. It's very hard for us to do our jobs now. Like back then, cakewalk. Now we have to document every little detail. Anybody that has a mortgage now qualifies for it. You still have
Right.
some party funky stuff going on. There's hard money that's not really regulated. People can do what they want behind the scenes, but I would say the majority, like 95% of all mortgages, are Fannie Mae, Freddie Mac, and highly regulated. So the ARMs nowadays, not only do they qualify for them, but they're not interest only. They're fixed rate, and typically how they work is it's usually 3-1, 5-1, 7-1, or 10-1 ARM. The
Okay.
3, 5, 7, and 10 is the fixed period of what the mortgage is at that point. So the mortgage will be fixed for 3 years, 5 years, 7 years, or 10 years. After that fixed period's over, now they amortize like a regular loan for the 30 years, but they can adjust, hence the adjustable rate mortgage. The second number, like the 7-1, that type of loan can adjust every month and it'll only adjust based on where the actual market is. They have ones that are like, they have so many varieties of that. There's ones that adjust every 30 days, quarter, monthly, you name it. 7-6 arm adjusts every 6 months. So the second number is just about the period in which it can adjust.
Okay.
But why are they not bad? Because at the end of the day, you're probably going to refinance in the next couple of years anyway. So
Right.
strategically, if you get into an arm and your payments are cheaper up front when you know you're going to refinance, it's not the end of the world, right? And or rates are going to be going down now, right? As
Hopefully.
opposed to going up, right? And those that got adjustable rate arms that like your fixed period expired over these last couple of years, it's been rough,
Right.
and I know a lot of people with home equity lines of credit, those are adjustable. Payments went really, really high. So it's a double-edged sword, right? Nobody's got a crystal ball. Every expert that I follow, we think rates are going down in the next couple of years.
Right.
If you got an arm and rates didn't go down over the next couple of years and you're in this thing 4, 5, 6 years, you're probably going to wish you would have got that fixed rate mortgage, right?
Right.
So it depends on the person. It's not the evil it used to be at all. We use it strategically and it's not for everybody. Some customers still are like, I'm good. And sometimes, depending on the market, the juice is not worth the squeeze. The improvement in rate over a fixed rate isn't necessarily enough to warrant you using that as the solution. So it's
Right.
for the more riskier customer, not kind of I want to just have the same payment forever
Right.
and not touch anything. So it's something that I don't take off the table. We've always present all options to customers, but to each their own. Some would prefer, some want to stick in the fixed camp. Some are fine with that adjustable rate camp. If it gets them a little bit better rate and a lower payment for the next couple of years.
Well, and so I just want to touch on something that you just said. So did you say that all HELOCs are adjustable rate mortgages?
Yeah, you can do fixed rate actually with HELOCs too, fixed
Can
rate
you? Okay,
periods.
because I wasn't
Yeah,
sure. I hadn't heard that before. I wanted to kind of touch on that when I heard you say that.
No, I'm glad you brought that up because that's not
Yeah.
necessarily a blanket term.
Okay.
The longer the fixed period, and the same with arms actually, the longer the fixed period, usually the higher the rate, right? So if there's a
Okay.
10-1 arm, that rate's going to be significantly higher than a 3-1 arm, right? And the same thing for HELOCs, but they're usually smaller periods as far as changes. It's usually like a year, 2 years, 3 years, something like that, as opposed to like 3, 5, 7, and 10, right? But it works the exact same way.
I mean, I guess if you plan to refinance in the next couple of years, because we all know that that's kind of, what we're all thinking when we get into these mortgages right now with these higher interest rates. Because
Mhm.
I mean, I don't think they're ever going to be to the 2, 3%, but hopefully they might be 4 or 5. I'm
Yeah, yeah, I'm hopeful
hoping.
for that too.
Yeah. So, and I think that we're just going to have to be patient because, I know with me and purchasing my home, I'm kind of in the same boat where it's like kind of waiting to find out like when is the right time going to be to finance or refinance, excuse me. So,
Well, I'm actually that's a really important point. I'm glad you brought that up. Right now, going forward, I think is going to be an extremely important time for people because there's companies out there, and I see this happen all the time, and I won't name names or the type of companies. They're usually the internet ones.
right. The
That
ones where
they
you're not
don't
getting personalized customer service, right?
Yeah, they don't. For me, I look at it like I'm your financial advisor for your home, right? I manage your mortgages, and for me, it's about helping my customers grow wealth. So I'm thinking relationship, where
Hmm.
you get an internet company, this guy or gal just wants to make a quick commission, and I've seen some pretty funny math done by some of these people to make people think that it's a benefit to refinance when they really shouldn't.
Right.
So you need to be very careful about that. I warn everybody out there, be extremely careful about that. And, the correct way to do it is see how much money you're saving and divide it by the cost. That's what people forget. It costs a lot of money to refinance, and that will give you a break even point,
Okay.
right?
So say that
So
one more
that's really,
time. So say that one more time.
so take the cost to refinance.
So like let's say it's $1,500. Is that correct? Like somewhere around there? Is that what you mean?
So I mean, it's the same cost when you buy a home. It's just you're using your equity instead of that. So it's likely like $10,000 to
Okay.
refinance.
Okay.
Now you'll only pay for the appraisal typically out of your pocket, which is $500 to $800 depending on where you're at.
Hmm.
Everything else though is, and then they just tack it to your loan amount. So, but
Okay.
it's your money, it's equity, it's so important.
Right.
And the worst thing you can do is refinance a bunch of times. Some of these mortgage companies would love you to refinance a million times, especially some of these unethical loan officer people, because they make commission every time you refinance. And so, there's a lot of funny math that could be had.
Right.
Hey, Mr. Miss, you'll save $100 a month over 30 years. Well, you're likely not going to keep the mortgage for 30 years.
Right.
And where are we at in the market and like what's going to happen? For my customers right now, we're riding the train to the bottom. We don't know when we're going to hit the bottom, but we're going to get as close as we can and just don't do anything. As long as you're okay right now, I'm hoping not to have my customers have to refinance twice to get the
Right.
lowest possible rate.
Right.
So fortunately, I'm a nerd on this stuff and I pay attention every single
Thank
day
goodness.
to
Thank
where we,
goodness.
yeah, where we are and what's likely to happen. And I invest in a lot of people that are much smarter than me to ensure that we reduce that. But for everybody out there, please be very, very careful as rates go down over these next couple of years. You are going to get these predatory calls. You are going to get these people reaching out to you saying, "Hey, you thought about refinancing?" And like I've seen some of them pitch it where it makes like 0 cents, like
Right.
zero, like people dirty by
Right.
refinancing them and harming them financially, which makes me sick. Like that's why I one of my little soapbox here is because I can't stand that.
Well, you
Like,
you
you know,
care too. You care
I
about your
care. Yeah.
clients. So,
Yeah.
okay, so I want to lead into another question really quick. So, when is a good time to refinance? So, what does the picture look like for a homeowner when they're getting, besides rates coming down, but like really how much equity do you want to have? I mean, what are those kind of factors that you look at when you say to somebody, it's a good time to do this, let's do it?
The old adage used to be 1% interest, but
You mean
situations
improvement?
boss. Yeah, improvement.
Okay.
7.25. If you got to 6.25, it's probably a decent time
Okay.
to refinance. Historically, that was the old adage, but it depends on the time. like a lot of experts think right now we're going to get into the fives, you
Hmm.
know. So that would suck if you got refinanced at 6.25 and then rates continue to go down to 5.25. Now you refinance twice. So if your closing costs were 10 grand, now you pay 20 grand when you could
Hmm.
have just sat it out and rode it to the bottom, which is
Right.
why the biggest reason why I warn people right
Hmm.
now to pay attention to what the deal is. I mean, there's some no-brainer situations. So again, kind of the math is take your closing costs, the total amount, get that
Okay.
number, and then divide that by your principal and interest in your current mortgage, or excuse me, I'm gonna confuse the heck out of people. Take your closing costs, right? Your
Well,
entire
okay, wait a
closing
minute. Can I
costs.
clarify? Can I clarify the closing
Yeah, yeah.
costs for the refinance or what you paid
Closing costs of the
initially?
refinance,
Okay.
right? Take the closing cost of refinance and see how much money you're gonna save between your old rate and your new rate.
Okay.
The best way to do that is look at your old principal and interest, taxes and insurance doesn't matter. Look at your old principal and interest on the old rate. Now look at your new principal and interest on the new rate, subtract that amount.
Okay.
So if you're saving $200 a month, you divide that by 10,000, right? And that will give you your break even point.
Okay.
So that's what I'm doing with my customers is looking at, what's my break even point? And if you refinance, um, before that break even point, again, you screwed up, right? The break even point is on that one, I had to do that. It's 4 years and 1 month would be the break even point on that,
Okay.
right? So, if you refinance it at 6.25 and then you had to refinance again, bad call, right?
Right.
But
Well,
if you get on the other side of 4 years, you're winning from that point forward,
right. And then
right?
another reason to refinance would be to refinance into another loan. Like if you wanted to refinance out of an FHA into a conventional, that would be another reason that you would want to refinance potentially.
Absolutely.
Okay.
There's a lot of people that are in, that have mortgage insurance right now. And obviously, the goal is to get rid of your mortgage insurance as soon as possible. That's a
Mhm.
huge factor, too. I mean, your mortgage insurance could be anywhere from $50 to $400 a month,
Right.
depending on what you have and your situation. So that's a significant factor in money that is being saved.
Hmm.
But again, and for some, I mean, a situation like that, it might make sense to refinance twice. I mean, shoot,
Sure.
get rid, you know what I mean?
Right.
Because your break even point's going to be so short. But the point is, situations boss and don't like let the data do the talking. Like, don't let some fast talking salesperson try to convince you he's doing something good for you. Because in the short term, if somebody says X amount off your mortgage, it does feel pretty good, but you could be doing yourself a disservice.
Right. Well, this is all good information. I know I feel like it applies to me and applies to some of our clients out there. Because everybody's talking about, when are they going to be able to refinance, waiting for
Yeah.
those rates to drop. And I thought the adjustable rate mortgage would be a good topic to talk to with people just because, I've been hearing more talks about it lately, like on different advertising platforms or different real estate professionals mentioning that they might be a good option for people. And I always, like I said, had somewhat of a stigma towards them. So, but in reality, when it comes to my clients and their loan choices, I have no part in that. That is something that I always, once I introduce them to, Keelan, I trust that Keelan is going to recommend the best thing. And that's not, people ask me about, well, how are rates or my credit score is this, or I've got this much in savings. And I let people know that their finances are not my business. I'm here to help facilitate the sale and the purchase of your home. And when it comes to the financial side of things, I leave it up to the professionals to be able to tell me, where are we at with our pre-approval and are we good to go? And I'm really looking up for a thumbs up or a thumbs down is what I look for. So,
Yeah, and I mean, don't fall for the like Costco of mortgages type attitude. These people get compensated. A company, I won't name names, gets compensated just for you to like literally
wait a minute. You cut out just a little bit. They get paid to do what?
they get paid and compensated just so to order an appraisal.
Oh,
So
okay.
like literally this sales guy's job is to convince you to refinance or whatever you're gonna do so he can get the appraisal ordered.
Got it.
Once that appraisal is ordered, he gets a commission. So compensation creates behavior. He doesn't even care. Oh, I hope he does. I
Well,
hope we're moral
hopefully,
people. But
right,
if we just think as compensation creates behavior, he's incentivized just to order an appraisal. And so different from how my business works and how your business works.
right,
We're referral based and we own our own companies basically.
right.
So any business that I have is based off of how good of an experience people have. And so my goal is to be your mortgage guy for life.
Mhm,
And so every move we make matters. Not only, I mean, and I wouldn't have my business any other way because I got in this business to help people.
mhm.
And that's just the way that I'm gonna be, regardless if and you see me spending a bunch of time with people when
You
it
do.
doesn't necessarily even benefit me just helping people with credit or anything like that financially. That's just me helping people and preparing them at some point, we'll get to a position you can buy a home.
Right. Well, I think the big lesson in this is don't make any moves without talking to a trusted professional. It's always good to get second opinion, get some advice. I mean, we've got our clients that Keelan and I have worked with over the last several years coming back because they're questioning, is it a good time to sell and buy a new home? So lesson is make sure that you're talking to your trusted professionals to make sure you're getting your questions answered and make sure you're not monkeying around with anything that doesn't need to be touched at the moment, or just to get some advice on whether it's a good time to make a move. So if you've got questions and you want to learn more about your opportunities to refinance, or you want to get into another home, or you want to buy your first home, go ahead and give Keelan a call. And if you want to, find out about what it takes to buy or sell in our current market, you can give me a call. My phone number is 206-330-6985.
And mine is 206-321-4941.
So, okay, well, Keelan, I appreciate your expertise as always, and I hope that you have a good weekend.
Yeah, you too.
Okay, thanks.